and welcome to Hilltop Wealth Advisors Economic and Market Update for the first quarter of 2022. I'm Curtis Bird, and with me today is Rusty Erickson.
Great to be here, Curtis. Glad we get a chance to chat.
I'm looking forward to it. Well, Rusty, 2021 was quite the year. We finished the fourth quarter of last year with heightened levels of volatility. There were several factors that led to this volatility, but one of the major players was inflation. There is a substantial exodus of workers from the labor market, which forced employers to raise wages to remain competitive. In addition to these heightened wages, suppliers were not as able to get goods to consumers. And so you could imagine, this created a mismatch of consumer demand and supply. In an effort to find some sort of equilibrium, suppliers were forced to raise prices, which had a direct adverse impact on inflation. Along with high inflation, 2021 was characterized by COVID and its variants. Just as we were adapting to the Delta variant, Omicron sent a jolt to both the markets and the economy. This spike in COVID cases certainly slowed the path towards a full economic recovery. However, the S&P 500 was able to gain almost 27% on the year. And this was mostly attributed to a strong rebound in earnings growth. In addition to that, the U.S. consumer as a whole was able to boost their savings. And this could be a helpful boost to the economy as it continues to open, as both goods and services become more available. So as you can see, 2021 was certainly action-packed. It ended up being a good year for the markets. But Rusty, should we expect more of the same going forward?
I think that's a great question, and one that the investment committee at Hilltop has certainly spent a lot of time thinking about. Here at the beginning of 2022, we've certainly seen an uptick in volatility, and we've seen some profit taking, particularly in large U.S. companies that are in the technology area. And that kind of makes sense, right? When we look back over the last several years, that's one of the areas that we've seen the most growth. And so taking some profits in that area seems very normal. But also when we look historically, right, on average in any given year, the market does decline 10% or more, even though on average the market is up for the year. So we know that, being an investor, we are going to have these periods of a pullback, though typically they are just temporary. So our outlook for 2022 remains cautiously optimistic. We continue to see growth happening here in the U.S. and internationally, albeit we suspect at a lower pace than what we've seen over the last year or two, just as we're farther along in the recovery from the pandemic. Mm-hmm. That being said, one of the areas that we are most optimistic about are the international investments. So if we look at investments outside of the U.S., the valuations are attractive relative to U.S. valuations, but those international investment valuations are also attractive relative to historic norms for international. So we suspect that this year could be a year where we see those international investments being a leading contributor to portfolio returns. But it's not without risk.
Right. I mean, some of the major risks that plagued 2021 will be the same for 2022. I mean, even though inflation has proven to be less temporary than what we expected, as the economy continues to open, spending on goods should moderate. As there will probably be a shift from spending on goods to those of services. Furthermore, as protection against infections increases, look for expanded capacity in the production of goods. And so this will kind of counteract that mismatch between consumer demand and consumer supply. As I was kind of alluding to with that discussion on inflation, another risk will continue to be COVID and its variants. Unfortunately, whether it's through inoculation, infection, or both, almost 90% of the population has some form of immunity from the virus. So this would suggest that the more seismic impacts of COVID are probably behind us, right? But it's definitely a cause for concern as COVID continues to mutate. Another risk to be mindful of going forward is the tightening of monetary policy. The Federal Reserve has already begun tapering its bond purchase program, but there is still some uncertainty around the timing and the degree to which they'll raise interest rates. And so as one would imagine, this uncertainty will likely show up as volatility in the markets. So Rusty, with that outlook in mind, with these risks in mind, how is Hilltop looking to manage the market in this environment?
And that's a really key consideration, right? So we have this data, where we've been, where we are. How do we synthesize that into how we manage the portfolio and how we invest? I would say for Hilltop, one of the key foundational points for us is always that well-diversified long-term strategic portfolio, right? That's really at the heart of what we do. And so that continues to be what we're going to lead with. That being said, we are looking to increase the diversification, for example, in the bond side of the portfolio. So bonds are historically part of the portfolio. They're there to reduce risk, to be kind of a safety net from the market. And given the environment that we're in, we want to add some additional diversification to that fixed income piece of the portfolio, given we suspect we'll be in a rising interest rate environment with elevated levels of inflation. We think some additional diversification there, some more nimbleness within that fixed income piece could help smooth returns during this time. Kind of at the other end of the portfolio, when we think about our alternatives, we've added real estate to the portfolio, and we are excited to have that as part of the overall portfolio. Real estate is a really diversified investment, and I know for me, when I think about real estate, I kind of first think about my house. I also think about the office building that we work at. But real estate is incredibly diverse, and we've seen that diversification only grow over the last several decades. So, for example, cell phone towers and server farms are a huge part of the real estate market and are a growing part of it. In addition to, distribution centers and warehouses as well. So we see real estate as a good opportunity right now. It historically has been a good hedge against inflation, and we see the valuations as being attractive as well.
So Rusty, when you talk about real estate, does that include the metaverse too?
Not yet. Not in the portfolio.
But in all seriousness, though, I mean, you said it. As we approach volatile times, I think it's prudent to pay attention to the fundamentals. Continue that diversified approach, and to really keep that long-term perspective in mind. Rusty, thank you for that. Thank you all for watching. We hope you all learned something of value. If this creates any questions about your particular investment strategy or your overall financial plan, we'd certainly enjoy hearing from you. In the meantime, be sure to check out our website and the Hilltop Views blog. Thanks again for your time, and I hope you all take care.